Today we take a look at the NIO share price to see if the downward trend of the past 2 weeks is over and if this is the best time to actually buy the dip or if the dip is not yet completed. So let's dive right in. Analyzing the downward trend. So when I made the massive NIO dip incoming video, a lot of people got upset calling it clickbait, and naturally I was proven wrong since the stock only dropped 17%. Now nobody that disagreed with the conclusion of the video gave any counter argument other than shut up, so I guess there was a consensus on the analysis. Now for a better understanding, check out the original video, but it basically comes down to institutional versus retail traders and investors, and understanding these market forces. Now the premise for the dip announcement was the increase of momentum surrounding the chip shortage. Like I stated in the video, the chip shortage was already present in December of 2020, however it worsened in the start of 2021. When you have such a clear disruptive force in the market, naturally institutional traders are going to react to this. They don't care about the company or the product, and they have a time horizon that's only 1 to 3 months. So to determine a massive shift in the share price, we have to get into the mind of an institutional trader and determine their situation. This means figuring out their entry and exit points. When looking at the NIO stock chart, we can clearly identify 2 points. The first entry point is around mid to late October, right before the first breakout of the stock, and the second entry point is mid to late December, right before the second breakout of the stock. So if you are a pro trader with a 1 to 3 month strategy and you bought NIO at $28 and at $43, you now find yourself in an avalanche of news concerning chip shortages and industry spillover from cars to smartphones to PlayStations, laptops, basically everything with an electron in it. And on top of this, you see the share price peaking at 62.7, 61.95, and at 62.84. So then the question becomes, what would you do? Obviously, you would get out of the trade and collect your profits. Now you could argue that based on the fundamentals, the stock would go up in the long run, but this is not relevant to a pro trader, so why would he or she risk losing such a large portion of the gains? Before we continue with the outlook on the share price, please like and subscribe to the channel for more finance and banking information. Now like I said in the earlier videos, I am a long-term investor in NIO, and based on the fundamentals, NIO will see strong growth this year as long as they keep the vehicle margins up and keep increasing the delivery numbers. But even as a long-term investor, you do not just blindly follow the CEO or the PR team, and you must not let emotions get the better of you. So when an obvious situation presents itself, you must protect your investments by hedging against it. Managing your risk is the most important element to long-term successful investing, and it even supersedes picking the right stocks, because every stock can go up or down, but if you control the downward exposure, you will actually start building some wealth. So now that we know how and why this downward trend started, we can now begin to determine when and how it will end. Well, the simple answer to this is when all the institutional traders have left the stock and you're left with the institutional and retail investor. These are the guys and girls that bought NIO for the long term with at least a 1 to 2 year horizon and are looking for hard data such as delivery numbers and profit margins. So normally after such a dip, you would want to see a slowing down of the drop and a clear settling level in anticipation of an upward swing. However, today we only have one data point, so it's hard to make any sensible prediction. There was, however, a very strong gain yesterday, indicating that the drop is either over or at least significantly slowing down. So this is an excellent time to collect the profit from the hedging and reinvest those in the long-term growth of the company. Now the stock may drop some more, however it's unlikely to drop as hard as it did before, and there are 2 major catalysts coming up to prevent any serious drops. The upcoming catalysts. So in addition to the actual slowing down of the drop in the share price, there are 2 major catalysts on their way to push the stock back up again. The first is the full financial overview of 2020 that NIO will release on March 1st, and the second are the delivery numbers for February. These February delivery numbers will tell us if NIO is facing any chip shortages and how the production output is developing for Q1. If NIO manages to deliver more cars in February than it did in January, the share price will most likely get back to January highs, and if Q4 turns out to be a profitable quarter, we could see a serious jump in the share price going forward. Most signs indicate that both the February delivery numbers and the Q4 results are going to be excellent, and thus we expect a rise in the NIO stock. It will not tell us anything about NIO's ability to continue increasing production levels throughout the year with the looming chip shortage, but I'm sure analysts and investors will address this during the conference call, and it will be very interesting to see how the company responds to any chip shortage and production questions. The NIO share price. So how will all of this translate to the share price in the near future? I see a lot of people screaming buy now quickly before it reaches $100. It's just unfortunate that they don't give any context to this figure. It just seems like a nice round number to them. With that said, $100 is actually very attainable for NIO, and it will completely depend upon the upcoming conference call where the actual results will be presented. If NIO presents negative vehicle margins with a higher delivery number, it doesn't look good for the $100. However, if the company manages to show a profitable Q4 of 2020 and a significant increase in the deliveries in February of 2021, then the $100 should be reached quite quickly, and we are looking at an easy $200 by the end of the year. Right now, everything hinges on NIO's ability to keep producing more cars, even though it will become harder and harder throughout the year to keep the production levels up. But if they somehow manage to do this, the share price will show many spikes each time the delivery and quarterly results come in. This was the update to the NIO dip. Please like and subscribe to the channel for more finance and banking information.